Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF conference, here with Sylvia Jablonski, who's Managing Director of Capital Markets, Institutional ETF Strategist at Direxion. Great seeing you.
Thanks for having me, Tom.
Another great conference. There's a lot going on with the markets.
Yeah.
What do we think about all this volatility?
So the volatility is pretty exciting, actually. If you're a trader, when you're looking for short-term opportunities, we've certainly seen a lot of big moves around everything from earnings, politics, China trade tariffs, the Fed. We've seen investors really embrace the short-term tactical trading tools around these times.
So you folks are one of the pioneers on inverse and leverage strategies.
Yes.
We've seen year over year greater adoption as advisors are not only comfortable with ETFs, but also these tools that are somewhat advanced to the average investor. Must have been pretty exciting when markets were declining at a great rate and then bouncing back in January.
It sure was. So if you look at the last decade prior to December, you had this low volatile trending market, and we never sell the products like this or promote the products in this way. But if you had a 3 beta tech ETF during that time or S&P ETF over the last decade, they were up in the thousands of percent. But now volatility is back and we see these short-term moves. We also see the short-term volume in response to those moves. So traders are looking for things like, hey, Facebook earnings were pretty good. Let's look at this 3 beta ETF called Talk and put on a trade for a day or two and capture that short-term alpha. I like to think that we democratized leverage. So RAs and family offices that can't have access to the tools that hedge funds do. They don't have prime brokerage accounts. They don't trade options. They might be constrained by certain things. Have this opportunity to generate those types of gains and hedge. So,
yeah. And do you feel that advisors are becoming more disciplined over time, especially because they have these types of tools, but also know they're meant to be used over a short-term period?
I do. I think the education effort has been paramount in that. So if you just look at the holding periods over the decade prior to December, they were longer. They were a week or two. They were sometimes longer than that because markets were low, volatile, and trending, and that risk wasn't really there. Now with volatility, we're really happy actually to see that traders are going in and out. They're going into the bull fund when we see a rally for a couple of days, and then they're going right back into the bear fund when the markets turn. So I think the education has really driven the point home that they're short-term tactical trading tools, and investors seem to get it.
All right, I'm going to put you on the spot here.
Okay.
Not short-term like the next week or so, but think about 2019.
Yeah.
Where might there be some good trading opportunities based on the way you're looking at the markets?
I like, there are two. So one is emerging markets. So if you look at EDC or 3 beta ETF that tracks emerging markets, emerging markets have been massively beaten down. They're at a multiple of 9 or 10. They've had some fiscal discipline, and because they've been beaten up for so long, as we see this global slowdown, those markets, which tend to do, sort of better, might outperform in coming years. If China actually has a GDP of 6%, that you want that allocation right now, right? The other really cool trade is just artificial intelligence you bought. So what's the next tech story? That's what people ask us. What's that tech L, that what's going to be up a couple %? You have robotics, you have, medical Da Vinci robots that do sort of the interventional surgeries. You have AI in factories. You have an aging population being replaced by robots. I just think that space is going to be huge.
Excellent. Always great seeing you. Thanks, Sylvia.
Thank you.